Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Luke, welcome back to the podcast, mate.
Thanks, Owen. Thanks for having me on, mate.
Hoping today we can talk about two things, one being small cap investing and the other one being, management or just people in general and the role that people play in investing. Because we're doing this Investor Bootcamp series, a 10-part series about research and an investment process, if you like. I'm hoping you can dive into two of those things because the first time we spoke on the podcast, which I'll put a link in the show notes to, Twitterati went a bit crazy over some of the scuttlebutts and some of the ideas you brought to the table in terms of how to find insights in small and micro cap companies. And then the second part of this is like, well, how do we deal with management? So how do you talk to management? I think there was one question, I won't take it away from you just in case it's on your list, but there was one question that you had that you seem to ask for all management teams, which I'm hoping you bring up today. And if you don't, I'll remind you of it. But I know I've sent it some loose talking points in advance. 5 reasons why small cap investing or micro cap investing, basically just small company investing, is interesting and a really good stomping ground for people to kind of learn how to understand businesses, learn how to comprehend balance sheets and all that sort of stuff. So maybe I'll just hand them over to you, and as we go through, I'll just chime in and hopefully add some value too.
Yeah, well, I think the beauty of it is you've selected two, I guess, at face value, separate topics about researching, investing in small companies, but then also how do you approach management. But I actually think that when it comes to small companies in particular, management, how you approach them, and the information and value you can get from them is so important. So I think they're two topics I think really relate well together and certainly very important to how I invest as a small caps investor. But yeah, no, look, I like I said, you sent me maybe a rough structure with maybe 5 ideas of investing in small companies, and so I've gone away and done that. I'll start with my first one. It's a really basic one, but small companies just have less eyeballs on them, less formal sell-side institutional research, less commentary on share market media websites, stock forums, Twitter, as you mentioned before. And so you naturally have inefficiencies in that market, which leads to opportunities. But what that also creates is, if you're someone who is looking to widen your experience base of researching, investing, and valuing businesses, it's an interesting place to have a go at developing those skills, because you don't have the ability to rely on other people's work. Why it may be a good entry point, if you're starting off in investing, looking at some large cap companies that are well researched and well covered, you can sort of use them to get some building blocks. I think coming back into small companies and starting fresh, standing on your own 2 feet, it's incredibly important, and it's something that I can speak to personally. That's sort of the journey that I took in my investing. You find yourself wanting to test yourself and push yourself, and naturally come into those pockets of the market where there aren't other people to supplement your work. It means coming down into the small caps. So I think it's such a important reason. And then it feeds into a second order effect of that is, like I said, there's also fantastic opportunities in small caps because of those inefficiencies. I mean, by its very nature of the market, if you have large liquid stocks with, think about the US, where you might have 20 to 30 sell-side research notes covering a stock, and a lot of large funds owning a stock with publishing their own research and spoken about on media channels and stock forums. The chances that stock is priced quite efficiently is very high. And usually your only edge as an investor is maybe something like taking a longer time horizon or something like that. But it's very difficult to add an analytical edge to your research because it's just so well covered by everyone else. But you come back into the small caps where you don't have that. All of a sudden, you can add genuine analytical edges. Your research can uncover, investment thesis and potential opportunities that simply other people aren't finding and looking at. So it's probably the biggest reason about why I think people would have a look at small caps if you're looking to build that knowledge base of investing and valuation. But also probably the most important because it's also what creates those opportunities for people.
So just to recap there on your experience, so did you start with small caps or did you go to blue chips and come back to small caps?
So right at the very start, I started in blue chips. I think when we did our first podcast together, I said my first two stocks were a couple of mining stocks. I got tips from mates. After that, I was buying stocks like NAB, Telstra, very much dividend focused, to be honest. And I think a bit of that was, when you look at most of what financial media coverage and even, I guess, financial advice in the public sphere is very much geared towards dividends and blue chips and things like that. So that's where I sort of found myself early on in my journey. But like I said, you naturally become attracted to the fact of, okay, these blue chips, I guess for certain people, that's what, that's all they need, and they can generate a nice, safe, steady and defensive return, I think, for some people. But if you're looking to really test and push yourself as someone, I was looking to get into the industry, obviously, but even someone who wants to just, research stocks a bit deeper as a side hobby, I think coming down into the small and mid caps is a great way to do it, because you'll naturally find yourself having to push your own skills beyond just relying on the vast wealth of information that large caps have out there already.
So number one is kind of like this analytical edge that you can get. And it's, that can be overwhelming for some people because they're new to investing. They're thinking it would be good to have a broker report so I can at least understand this business. But I find there are also sometimes at least simpler business models as well, like the kind of true to form, more pure business models, whereas a blue chip can be kind of unwieldy. What's your number two?
Well, you've led me right into it. So my number two was
we didn't
literally
plan this.
simpler business models. And I think a few things to talk about here. So first of all, small, micro cap, small cap, and even up into mid caps, you generally have much cleaner business structures. So investors don't have to worry about debt, minority interests in other businesses. You see a lot of that when you get up into the large caps, and to be honest, even well-seasoned investors can struggle to pull apart some large cap businesses. But even from an operational point of view, you generally only have one product or service, and it's usually only in one geography or region. So it becomes relatively more simple to analyze from a industry perspective, a competition perspective, even growth and maybe addressable market analysis becomes a lot easier. As you move up into large businesses, you often find a handful of product and services. They've got operations all over the world, and you see that if you look at trading updates from large businesses, you'll often see one segment doing well while one's doing poorly, one geography is doing well while one's doing poorly, and so there's a lot of complexity to pull apart there if you really wanted to go deep into the analysis of that business. Whereas if you come back to some of these smaller businesses, they're usually much more hyper-focused. And while it can be daunting if there isn't other research or information out there to build your knowledge base on, the fact it's a simpler business makes that task a lot easier. You really only have to get your head around one product or service or one key aspect of the business. So I think that's again, that was my second reason. I think it's a valid one because from an investing point of view, I think Andrew Page at Strawman, I've heard him say this a few times that you don't get points for complexity. It's making investing as simple as possible is the best way to do it. So and small and mid caps I think usually give you that, whereas the further you go up, usually the more complexity, just from size brings complexity for a lot of businesses.
I think that's true when you're learning to invest and when you're learning to research businesses. I find small caps so very compelling because you only necessarily have to understand, not always, but sometimes, one business model that a company pursues, one strategy, and you also get that kind of, oftentimes there's like one core product or one core service that they deliver to the market. Sometimes, there are some examples in your portfolio where there are businesses that do a few different things in different geographies, but you can kind of evolve with that story as well as it grows. So that's really compelling too. So I like that simplicity. Like I'll give you a counterpoint, which is a company called EML Payments. It's now come back a bit. So it's not necessarily like a blue chip company, but that has operations right around the world, does payments technology, services hundreds of different clients and users, and it becomes very overwhelming. So when you're starting investing, even though it might be an interesting company, it could take you a very, very long time, and you just throw your hands up in the air and you think this is too complex for me. So yeah, I fully aboard that second point there. Really good points, mate. What's number 3?
Yeah. So number 3 is, so far, I guess we've spoken about analyzing a business. And I think that's really important and gets lost on a lot of people. But of course, the price you pay is really important. It's probably the most important thing. Absolutely. So developing techniques to value these businesses at different stages of their life cycle and understanding the difference between price and value, I suppose. So when you think about large caps, generally speaking, most valuations, because they are profitable, generating cash, you fall back to your traditional valuation metrics of PEs or discounted cash flows, and they work quite well. And so for most people, and because they're usually big, steady businesses, like you think about a Woolworths, a Brambles, an Amcor, those big defensive businesses, you can usually model them out a few years into the future, probably get their growth rates to within 1% or 2%, spot on. And so the valuation becomes, is this cheap compared to maybe the market, or is this cheap compared to its historical ratios? That's generally how you approach valuation. When we come down into small and mid caps, you really have to evolve that thinking, because these are often businesses that may not be profitable, may be burning cash, but almost certainly under earning. And so what I mean by that is when they're early in their growth cycle and they're investing through their profit and loss statement, maybe by building out an employee base before the growth comes in, or investing heavily in R&D, or trying to move into a different geography or region, or whatever it may be. It's muting that profit line. The business isn't, profitable to the extent that it could be at a steady state. So coming up with a valuation becomes trickier. A traditional PE model won't work, because this business may trade on 100 times earnings of what they reported last year. But if that business is, investing very deeply into their R&D, and if that either winds back to a more sustainable level, or, as what happens in most businesses, that expense base sort of stays flat and the operating leverage starts to open up, that earnings base can accelerate so quickly that you see it all the time. Those PE multiples drop so rapidly as these businesses really grow, which is always easy to look back on when it happens. We can often find examples of a business that traded exceptionally expensive, but then really grew into its valuation. Finding that at the time is often incredibly difficult, because you're trying to forecast years out. And so there's different ways, I guess, of trying to put pegs in, square pegs in round holes. People have used price to sales as maybe a way around it. I say gross profit being used. I'm not saying any of those are right or wrong. They're just different tools you can use as an investor. And I think small caps gives you the opportunity to test a lot of them on different business models to see, how it compares to peers, or how it's compared to itself in the past. For me personally, I think I spoke about this when we had our first conversation. I like to think about it in the sense of a business building up its earnings engine. And so this is a business that at some point in the future, what sort of earnings can be, spat out of this business as it reaches a bit more of a maturity through its life cycle. I try to focus on that maturity phase being within maybe 1 or 2 years, maybe 3, if I'm really confident on where a business is going. If we sort of look back at what's happening in the current market with a lot of high growth tech stocks, if you think back to last year, I think that time horizon was very, very long, and people were they were looking at where businesses could be in 5, 7, 10 years.
Yeah.
And I think that gets very, very risky. And of course, with all the uncertainty going on, it doesn't surprise me that a lot of de-risking has happened in a lot of those sorts of evaluations. But, for most small cap businesses, having some sort of view of where those earnings could be in a reasonable time frame, like I said, a couple of years. That's sort of how I think through valuation, where you don't have those traditional metrics to fall back on.
And so you're saying like that 1, 2, 3 year window. Are you using things like comparable companies that might be ahead of the curve, or like a slightly more mature player in that market? Or is it pattern recognition for you over time? Like, how do you get that insight?
Yeah, it's a good point. It's probably a little bit of both, to be honest. Like, you definitely could always point to more mature peers or maybe overseas peers, which is a little bit dangerous because overseas markets can sometimes trade differently to Australia. Pattern recognition's, I think, a big one though. Like, you definitely get a feel for what sort of businesses, what sort of business it is, and what level it can trade at a certain point in the future as it approaches that maturity level. So identifying, okay, it's a more medium quality business, but at a mature level, the market has historically paid 12 to 14 times earnings for this. I think it's on about 7. You can start to make some cases for how you see a share price playing out in a reasonable time frame. So that's matching, I guess, those two. Or I guess the 3 points we've discussed of you're doing your business analysis to make sure that if you're taking that reasonable time frame, say a couple of years, the business analysis is making sure that the business executes to what you want to do. And then the valuation comes in and says, well, what price am I paying today, assuming my business analysis plays out to of course, you always have upside downside scenarios, but to a base case scenario, what am I paying today? And if you do that right, what I love about small caps is you'll often find times where even if the business doesn't fully execute to what you think, if you've got a big enough margin of safety when you first bought, you can often do okay, or at least not poorly. The problem you have as you go further up into large caps, where you have a much more efficient market and more eyeballs on it, is that margin of safety usually disappears as well, because the price is much more aligned to the market's expectations. So when you see mid and large cap businesses miss expectations, the share price reactions can be savage because there wasn't a margin of safety built into the price to begin with, and so when the market panics, it overreacts to the downside. So that's the third one. It's very important. To be honest, it's probably, for someone who is either new to investing or early in their journey, it is the most difficult part to do, because I think even from a business analysis point of view, most people we've worked in businesses where, a lot of consumer businesses, you're familiar with brands and all that sort of stuff. Business analysis is not natural to people, but can be picked up quite quickly, and you can apply your own experiences, sometimes even as an employee, to the business analysis. But valuing the price of the stock you're paying today, I think it's the learning curve most people have to find, and I think it probably just takes time. And you put it very well before. It's a lot of pattern recognition, I think, as to how the market will value these businesses. Because look, at the end of the day, from a theoretical point of view, we can both sit here and say, what's the value of the stock today? Well, it's the discounted, cash flows it will spit out in perpetuity. But we know that in this imperfect world of changing expectations and how the businesses change over time, we can't do that. So we have to develop, I guess, these shorthand metrics for ourselves to try and value these businesses and find opportunities.
I would say that's probably one of the more difficult things for smaller cap investors, like smaller company investors, because it's almost like the tools. You need to understand the tools as well. So you need to identify what the pattern is and then choose the tool for valuation. Whereas, say, like Woolworths, Coles, Telstra, industrial companies, they have cash flows. So you probably can value them, like you said before, with a discounted cash flow analysis and a PE ratio. It's quite standard because they're consistent in their earnings and what have you. How about number 4 then? So we've moved from like some business analysis and why small caps. We talked about valuation. What's number 4?
Yeah, just quickly on that, on a point that you just raised about understanding your tools. like I said before, the last couple of years, I think we saw the rise of price to sales as a valuation metric, and I think that started with a very genuine reason, because you had these software as a service businesses that have some really unique characteristics, where exceptionally high incremental gross margins, meaning that your single line of code, every new customer you win, it's essentially 100% margin, or close enough to it. And so when you have that sticky revenue coming through at such an incremental high margin, it made a lot of sense for these businesses to spend very heavily in trying to acquire customers that would then stay on a sticky platform. And so price to sales actually, I think, was quite a rational metric for SaaS businesses, and provided a lot of value. It got a little bit bastardized, though, and was starting to be applied to any loss-making business. And I think it goes back to your point of understand your tools and where they're best used. And so I think there's been a market reckoning over the last couple of months for a lot of those styles of businesses. And I think a big reason for that is people were misusing that tool. So very good point. Understand your tools and understand whether they can best be used for different businesses. Number 4, I think, we've probably touched on this a few times, but it's quite a simple one. You just have a bigger variance in outcomes. And so that provides you opportunity, but also, I guess, interest as an investor. Like I said, there's certain investors who, big defensive blue chip businesses, I get why you want to own them. It may be a time in your life where you're in capital preservation. But to be honest, I think for most people, it's just a lot more interesting researching a business where the variance of outcomes is quite wide. If a business can really execute, and a management team can drive penetration of a large global addressable market, not only do you get the validation of usually a very strong stock price with that, but you get to see this thesis play out where the business executes either to your expectations or better. And so it's a really good positive feedback loop to have as an investor. Whereas compared to, as we were talking about before, take a Woolworths or a Coles, we can pretty much sit here today and tomorrow and say, in a year from now, their revenue will probably be up between 3 to 5%. And that variance in outcomes is quite small, which means as an analyst, you probably don't add a great deal of analytical value to the work you're doing. Whereas in small caps, that variance is quite large. And so then again, it sort of all interplays together. So understanding that variance, you may have this wide range of outcomes, but you have your classic bell curve, and it's where do we sort of sit in that bell curve? So we have this fat tail at either ends. But where's my most likely outcome? Is it more towards this business really executing or doing well, or are we in an environment or a business where that's actually more likely that some of those negative outcomes, it's more likely weighted to be a negative outcome than positive compared to, I guess, maybe where the market's thinking. And then, of course, overlay valuation onto that becomes another key aspect. You may have a business where, even from a base case, it's factoring in some negative outcomes. But if the market's pricing even worse than that, then you can still do okay. But I think it's really interesting, and it's often at the time, we had these small cap businesses and they may be growing strongly or doing quite well, but it's usually only after a few years. And a point you made before, I think, is a very valid one. Even as analysts, you often grow with these businesses and develop new understandings of them and new perspectives on them. And it's always interesting sometimes to look back and see, where has the business come from where I first expected it to be. And hopefully, if you've done, good work or the businesses have executed, it may be, just as good or better than what you've hoped. But even if you haven't, or even if it hasn't, maybe that valuation is sort of providing a bit of a softer landing for you anyway. But I think just the interest that I get from this wide variance of outcomes in small caps, it's why I naturally lean towards them.
I find those 2 points, 3 and 4, to be really succinct in that, we know that the formula for expected returns is basically the probability of an event multiplied by the price at that time or the valuation at that time. So, for example, if you have your bull, base, and bear case, what's the probability of those? The variance in small caps, they're further apart, right?
Yes.
But the valuation you can work out if you have those scenarios. And so that's where it gets really interesting, is like, you might have a probability of this, like you said, on the bell curve. I might have it at this rate. And then all of a sudden, that's what creates those opinions, informs evaluations. And that's where it gets really interesting, because you might discover something because no other analyst has covered it. I haven't covered it. Someone else hasn't covered it. And that gives you more conviction in your probability, which I think makes it really exciting too.
Yeah. And I think it's really interesting as well, because you need to have that. Like, we're talking about under research, under followed, and often illiquid markets. And if you're able to build your conviction and grow your conviction, that's so important, because that will often come in the face of, sometimes a negative share price. If the market's not seeing what you're seeing, the share price may be performing poorly, particularly in a market like this, where, overall there's some negative sentiment around. So it's important that you're not being blinded by the signals being given off by the market, or even in the stock price itself, that you're focused on where is your conviction coming from, and is that conviction still there? Now, of course, I guess it leads us to a part of the conversation of what happens if your conviction is wrong, and how do you know your conviction is wrong? It's often so difficult to do, and it's probably under discussed by a lot of people. How to identify when you've made a mistake. I think everyone accepts sort of, the correct course of action or philosophy is, when you identify a mistake, you exit and move out. But identifying when you've made one is often so difficult, because like I said, you were just saying, you build up your conviction, and often your conviction can grow based on the factors you're looking at. But if you're not seeing the forest through the trees, there can be problems there. So, for me personally, that's where I'm always looking to bounce ideas off people, and why I've never been afraid of putting ideas out into the public domain, just so I can always have that sort of critiquing. You don't want to be stuck in an echo chamber where you have really deep conviction in something, but it's not right, and of course you're stuck there. While there's plenty of valid reasons that maybe you're not seeing, or a different perspective of how other people may look at it, whatever it may be. You need to be open to that, and willing to hear those other opinions.
Yeah. For people that don't follow you, Luke's was one of the, I feel like you're like a charter kind of power user of Strawman, and like prolific on Twitter too. So he's worth a follow, and I'm sure you'll get a chance to share your opinion with Luke if he tweets. Mate, how about the fifth and final one, for like 5 reasons why small cap investing is like a great place to develop your investing skills?
Yeah, well, we'll use this one to then, I guess, move into the second part of the conversation. But I think there's just easier access to management in small caps. So,
definitely.
If you're looking at a large cap company, I think best case scenario, you may be able to get a phone call with the IR department, investor relations department. Most small cap CEOs that I've come across, obviously now with Merewether Capital being a fund, that access is a little bit easier. But even in my time as a private investor, I could probably count on one hand the amount of times where I wasn't able to get a phone call with a management team. By far, most of them are really happy to talk about their business. Most of them are usually founders, and they don't have people knocking down their door every day to talk about the business or the share price. And so, if you're the person that sends them an email out of the blue and says, "I've stumbled across your stock, however you may have done it, would be interested in a chat," most of them are really happy to do it, and happy to tell their story and provide more context to the business. And I think you get a much deeper understanding than talking to an investor relations manager who has their A4 page of dot points that they're able to talk about, and then a long list of stuff they're unable to talk about because of restrictions or whatever it may be. So I think we might take the conversation into talking to management. I think it's so important, and I think small caps give you a much better access to that, even as a private investor.
And as we segue into this, I often find that if you think about it, it's like a smaller team, and a smaller overall business. So oftentimes management teams can have a bigger influence on everyone or everything that a business does. So I've also asked you to bring like to the table some questions that you could ask basically any management team. Last time you had a great one, which I don't know your question, so I'm gonna see if you bring it up. If you don't, then I'll remind you of it. But yeah, let's dive straight into that. So company management, so important to investing. It's part of the qualitative side of research. How do you go about it, and what questions do you ask?
Yeah, well, you're right in that introduction. So for a small cap company, you think about a large business, like think about something like a Telstra. Had a revolving door of CEOs, and not much really changes in that business because it's so bureaucratic, and it's just systems and processes that have been in place for decades. Small businesses are the complete opposite. It's dynamic. It's always shifting. Your employees are always at the front of the business, and so maintaining a good culture and maintaining a good workforce, it's so important. Let alone all the decisions they have to make around strategy and capital allocation and all sorts of stuff. So I do always try to speak to the management teams. Like I said, most are usually happy to do it. I've come across a couple who sort of take the view of, we run the business, and if you want to own it, you can. But nonetheless, most are happy to chat. So one of the questions I usually always ask is something along the lines of, who are your competitors, and why would customers use them instead of you? And I think this gives you a couple of things to take away. The first is, you get the list of competitors, which is sometimes obvious if you're talking about retail brands or consumer facing businesses. You often know who their competitors are. It's not a big deal. But for a lot of industrial businesses or enterprise businesses, their competitors can be businesses you've never heard of or based overseas or whatever it may be. So just getting that list of, okay, here's your list of competitors. What can I do with this? And one of the most obvious ones is, if they're listed, go and look at their filings, whether on the ASX or maybe overseas, and how are they performing? What's their commentary like? How do they see the industry? Do they call out the business you're looking at as a competitor? A lot of things can be done there. The second part of the question, I think, is also important about how the management team are approaching the strategy, which is, why would a customer choose your competitors over you? And a lot of the times the answer may be something like price, or like the competitor may have features that they have, or whatever it may be, whatever that answer is. It gives you an insight as to how the CEO or that management team view their competitive structure and what they're trying to achieve within that. So take price as an example. It's always an interesting one. A lot of businesses take the view of, we try to be a premium product in a market, or maybe the other side, we're a discount product in the market. So we know where we sit. That's what we try to capture. We don't come down into the discount, or we don't move up into the premium. And that's often a very valid answer, and it gives you some perspective over what they're trying to do and how they're going about it. But where you get some real value is in stuff like where they feel their product may be behind competitors, and so you'll often get insight as to where investment might have to be made to bring a product or a service up to scratch, or where can they improve themselves, or if you have a services business that maybe doesn't have a footprint across all of Australia. So, maybe some people choose our competitors because we don't have a footprint in WA. There's lots of different examples, but it gives you a great perspective as to how they are thinking about where they are in their industry and against their competitors. You can even go a bit further into it as to how aggressive are their competitors. Are you in a structure where it may be a cozy oligopoly and everyone sits there content with what they've got? Are you in an industry where there's a price war going on and you're competing heavily against your competitors for market share to either retain or win that? That may be a business you're looking to avoid at a certain point in time. It can be very difficult when businesses engage in price wars to try and capture or retain market share. So, that's always a question I ask, and it gives, I think, some really good perspective on an industry and where they sit within it.
When you said that, it actually reminded me of a conversation I had with a CEO and CFO last week, where I identify one of their competitors and something that they've done historically. but this company that I was researching has just come out with this new software and this new, basically like this platform that wraps around the hardware. And I said, oh, your competitor's not at this level yet. And they said, well, actually, and then they said, you might not know this, but our competitor who does the hardware is actually owned by another company which does software. And so they're bridging that divide already. So I didn't get that insight until I asked that question, like, who is the competitor that you're most concerned about? And they volunteered that information, which was really interesting because now I know who I need to watch, basically, like who's snapping at their tail. So that's a really good question. I like that. And sometimes I think it's worth mentioning that some CEOs and some management teams won't be super candid. Sometimes they will say, I've heard, the amount of times I've heard we don't have competitors. That's a good one because that they do. Every business does. But great first question. What about number two?
So number two probably goes into something you just said about sometimes difficult to get a candid answer out of them, which is just what are the biggest challenges facing the business, let's say next 12 months, pick a reasonable time frame. And I think naturally, when you speak to these management teams, they will paint a positive picture for you, and oftentimes that's not malicious at all. Like I said, a lot of times these small businesses, it's often the founder still running it. It's their, it's their baby, it's their business. They want it to do well, and it has done in the past. So you have to bring the perspective to the conversation. And so for me, what that means beforehand is researching the company before I have a conversation with management, for the simple reason of, if I have a blind conversation with management without having any sort of perspective going in, I'm a blank slate for the positive story that will be put in front of me. If I do the work beforehand and I have my list of questions and I have potential issues, challenges, whatever it may be, then I can be, the foil to that positive story and be able to not necessarily pick it apart, but know when and where to provide some context to it. But a question like that, I think, cuts through that positivity and says, okay, what are you worried about over the next 12 years? Where can this business trip up? And to your point before about someone who says there's no competitors, like if you get an answer from someone along the lines of, we have no, there's no issues, everything's absolutely flying, it's probably more of a red flag than someone who is brutally honest and says, we have half a dozen issues that keep me up every night, sort of thing. So I think it gives you then a good perspective to go away, because that's what you're really trying to do when you talk to management teams. You're looking to, like, no management team ever just says, here's what my business is going to do next year, X, Y, Z, you should buy my stock and whatever. It's just providing little pockets of information and context to the research you've already done. And so if you're able to better understand the challenges that management see, you may be able to try and track them in the background. So, let's take retailers as an example. Right now, every retailer is saying supply chain issues, wage cost inflation, some of the problems they're facing. As an investor, you now know these are the things I need to be keeping an eye on. And are these things getting worse or are they starting to abate? If they're getting worse, then, do I need to revisit my investment thesis or revisit my valuation if I think they're getting worse while the share price may have held up okay, maybe overvalued compared to what's really happening behind the scenes. But it also gives you some perspective as to where is management focused. A lot of times, I'll come into a conversation with what I perceive to be the biggest challenge facing them. That may be, they're a small business to a large competitor, or, it may be new technologies coming in and encroaching on what they do. And then when you speak to the management team, not to say that oftentimes it's dismissed, but for them, they may not have as much weight behind those issues. There's other things they're focused on, and they may think that the issues that you thought may be problems either aren't as big or potentially maybe outside of their control. And so, let's focus on what we can control. So I think you get a good perspective on, like I said, cutting through that positivity. Let's get to, okay, what does keep you up at night? What are the issues? How can you address them? It sort of ties into that conversation as well. Because I think what gets a bit scary is when you see businesses that have issues that they can't control, that becomes a problem. Like if you are dealing with supply chain issues or input price problems, but you're a fixed price contractor, that's a problem. If you're someone who can, take those input cost pressures, but pass on a price increase to your customers, okay, you've got issues, but you've got actions to try and mitigate them. So that's what we're really trying to get to as investors, to try and understand, how these management teams are seeing their business, seeing their industry, and reacting to it.
Yeah, I find that's fantastic. And every business should have risks, right? Like every business should have something. So it's a great way to identify, to weed out certain answers, and to identify, understand who you're talking to as well. I feel like that's a valid way to do it. Okay, so I'm secretly hoping that you're going to bring us the question that I think you're going to say, but if you're not, then that gives us a fourth. So what's your third question that you almost always can ask a management team?
So the fourth one is, what are the metrics that you use to judge yourself?
That's the one.
What can I do to sort of track that? So I think it's such a good question because, like I said, if we think about large caps, usually the main metric that is driving these businesses and driving the incentives of these management teams is profits and earnings and EPS, which makes sense. They're usually mature businesses, and that's the life cycle they're at. You come back to small caps, usually, obviously they're businesses that want to get to profitability and get there at some point. But when you're talking to them earlier on in their life cycle, there may be other things that they're focused on ahead of that. And so trying to identify, we just had this conversation about trying to identify the issues that management sees. Well, let's sort of flip that question on its head. Like, let's talk about, what are your opportunities? What are you focused on? What are you excited about? And where I think I get a lot of value out of a question like this is, you have businesses where you may have a core business and maybe a new product they're developing R&D, and you have a conversation with the CEO and you quickly realize, he's really excited about this new product. And right now it's not in the numbers. It's not, it's not contributing meaningful revenue or profits, but that's the focus. And it may be the future of the business if they're able to execute and grow. And so it's an insight that you may not have gotten just by looking at raw numbers, or sometimes, for some management teams who are quite conservative, or they're a little bit cautious about, putting certain things in public market filings if they are doing some R&D or developing new products. You get some perspective you just otherwise wouldn't have got. So then, similar to talking about the issues and the challenges, the next flow on to that is, okay, so this is what you're excited about, and this is what you're benchmarking yourself to. And it could be something like a new geography, where we've got a very strong presence in New South Wales or Australia. We're looking to move to the UK or New Zealand. So, in the short term, that's where a large part of my focus is we want to grow there. So, okay, next time you report, well, what's UK growth done? Is that executing well, or are there challenges? So it gives you, as an investor, it lets you know where to look, based on where management's really trying to grow value, focus their efforts and attention, and then also, I think, just gives you that opportunity, like I said, because the market's usually so focused on the here and now, is that if you can sort of take that little bit of a longer time view and sort of share their, again, you don't want to be sucked into drinking the Kool-Aid or share the excitement, but if you can sort of say, okay, well, if they're able to execute on a geographical expansion, or if they're able to monetize a new product or service, or if they're able to pivot their product to a new vertical, what does that mean? And what the numbers be in a couple of years? That's where I think it goes back to our conversation about a wide range of outcomes and variances. But that's where it gets really exciting for small cap investors. If the market's not pricing in that upside, that's where I usually get quite excited.
Yeah. And again, I'm remembering back to this conversation last week, because a lot of this rings true to that. In that conversation, they say, like, we've got this hardware unit and where there's a software component that comes with that. And they've launched this software component. And the way they're measuring that, which I hadn't heard them talk about before, is basically, if we get X number of hardware units or installed devices into the market, then we convert to the software subscription. What's the percentage that we convert? So there's a few variables there that they're tracking. How do we get the number of installed devices into the market, and what's the conversion rate, basically? And so from that, as an investor, then I can follow up, in 6 months and say, well, how many installed devices are there? How many devices did you get into the market? Yep. And that's a fantastic way. Like, I wouldn't have thought to have asked that specific question, but that was the number one thing that was on the CFO's mind. And so that was part of their strategy to lower prices, to get more of these devices out there now, to then to switch them over to software in time. So I think that's a fantastic question. And that's the one that I knew, I didn't know, but I figured it might be in your top three, because a lot of people have taken that. I know on Twitter in particular, taken that question. Now they apply it to their companies as well. So you're a bit of a thought leader there, mate. I like it.
And to go back to your example, without even knowing the business, I'm going to make an assumption that the numbers they're reporting today are probably very hardware driven. Yep. And so what that means is that there's a bit of an edge there, because if the market's focused on the here and now and the numbers that are coming out of the hardware division, but that management have a strategy to maybe loss lead that, or whatever the strategy might be, to grow the conversion into the software, then the next report, it may be a disappointment to the market that's focused on short-term numbers on a hardware division, but if that conversion is high and that software is growing, then as an investor, your thesis could still be playing out quite strongly. And it goes back to, again, a point we made before about your conviction in a stock can often increase in the face of what may seem to be a weaker market. As long as you're focused on the right things, then you'll do fine in the longer term, for sure.
Yeah, and that's the way I interpret it as well. So the shares are down. So that's a good one. That's a good one. Maybe we can have a chat off air. But mate, you've brought like 5 great reasons why investors should think about developing their skills as small cap investors and analysts, and also then brought 3 questions that I think are fantastic to ask to any management team if you get the opportunity. So I'll put all those in the show notes. And if people want to reach out to you, they want to find out more about you, read your letters from the fund, where can they go to do that?
Yeah, merewethercapital.com.au. Got the fund letters on there. I've got a blog that I'm trying to keep more up to date. I wish I did more on it. It's more about finding time, where I post some sort of deep dives into a couple of stocks in the portfolio. Follow me on Twitter at Luke Winchester 9. And if anyone ever wants to have a conversation either about investing or about Merewether Capital, Luke at merewethercapital.com.au, shoot me an email. Always more than happy to chat to people, and in particular, like, I think if people go back to the first conversation we had, my entry into the industry was effectively from the outside, coming in quite unorthodox. So I'm usually very open to anybody starting off in investing and just wanting to ask. I've been there. You sometimes don't want to ask a dumb question, but if you ever want to ask me a dumb question, shoot me an email. I'll, I've probably asked it before myself.
Yeah, likewise, mate. That's great. So Luke's a fantastic resource online. So I'll put all the links in the show notes, mate. It's always a pleasure. So thanks for joining me.
Awesome. Thanks, mate.